All right, let's jump right in. Today, we're taking a magnifying glass to a widely held assumption in the financial world. If you ask the average investor on the street what Schwab is, they'll almost certainly tell you it's a discount broker. You know, a place where you open an app, tap a button, and buy a stock for $0. But if we look at the raw data, that description isn't just incomplete, it's honestly an illusion. We need to put on our macro strategist hats for a moment and look right past that retail storefront. Schwab is not just a broker, it's a highly sophisticated, diversified earnings engine. So let's dive into this explainer and uncover the actual business model powering the absolute king of retail brokerage. To absolutely shatter that discount broker illusion right out of the gate, we really just need to look at one staggering figure. At the end of the first quarter of 2026, Charles Schwab reported $11.77 trillion in total client assets. Trillion, with a T. You do not gather nearly $12 trillion just by offering a cheap trading ticket. This metric alone proves the sheer scale of their retail balance sheet ecosystem. We're talking about everything from retirement accounts and ETFs to bank deposits and margin loans. Schwab isn't just facilitating trades, they're essentially warehousing a massive percentage of overall American household wealth. The absolutely crucial point here is understanding what Schwab is actually selling, and that is trusted financial account aggregation at a genuinely enormous scale. Today, Schwab boasts 39.1 million active brokerage accounts. The zero commission trade? Well, that is merely the front door. It's the shiny welcome mat specifically designed to get you inside. Because once a client walks through that door, what happens? They bring their tax forms, their beneficiary designations, their emergency cash, their long-term retirement goals. They aggregate their entire financial life in one single place. And once those assets are aggregated, that is when the real monetization begins. To pull this off, Schwab operates on a brilliant three-layer business logic. Layer 1 is lowering the visible price. Layer 2 is monetizing the invisible balance sheet. And Layer 3 is deepening the relationship. Let's unpack exactly how this playbook works. Starting with Layer 1, asset gathering, or lowering the visible price. Ever since they aggressively slashed commissions to literally $0 back in 2019, Schwab positioned itself as the ultimate champion of the everyday investor. But we have to look at the dichotomy here. On one side, you have the visible price, $0 commissions. It looks incredibly consumer-friendly, right? But on the flip side, you have the invisible balance sheet, your idle cash, margin loans, and bank deposits. Schwab can afford to give you the front end entirely for free because, frankly, the back-end economics are just incredibly lucrative. Which brings us to the real core thesis of this explainer. Layer 2, the cash engine, and exactly how they monetize that invisible balance sheet. The secret sauce is that once your money arrives on their platform, your uninvested cash basically becomes the low-cost raw material from massive spread business. And the hard data absolutely proves it. If we look at Schwab's 2025 revenue, net interest revenue generated a truly staggering $11.75 billion. Compare that to their trading revenue, which came in at only $3.9 billion. The zero commissions didn't destroy Schwab's business model at all. They simply revealed what the model actually was. Now, to fully grasp how this machine works, let's slow down for a second and define a critical banking term, net interest margin, or NIM. NIM is just the spread between the interest Schwab earns on the assets it holds and the interest it pays out to fund those assets, like the yield it pays on your idle cash. As of the first quarter of 2026, Schwab's NIM sits at 2.88%. Now, 2.88% might sound like absolute pennies to you and me, but when you apply it to a literal mountain of cash, it generates billions. Specifically, Schwab reported $461.5 billion in client transactional sweep cash. That is an absolute ocean of low-cost funding fueling this margin. When we break down exactly where that monetization happens, the numbers are wild. In Q1 2026, there was that $461.5 billion in sweep cash. Then you add $126.7 billion in margin loans, which is when clients are actually paying Schwab to borrow money to buy more stock, and then another $60.9 billion in bank loans. The sheer massive scale of that lending ecosystem is pretty breathtaking. Moving on to Layer 3, sticky custody, which is all about deepening the relationship. You see, Schwab doesn't just want you to trade and bounce. They want to be the friction-filled setter of your entire financial life. But here's the twist. Perhaps their deepest, stickiest relationship moat isn't actually with retail clients at all. It's their B2B business. Schwab Advisor Services acts as the invisible plumbing. really the operating system for thousands of independent investment advisors. By providing the underlying infrastructure for all these advisors, Schwab securely locks in long-duration B2B assets right onto their rails. Okay, let's do a quick recap of this complete structural breakdown before we move on. Number one, they gathered $11.77 trillion by offering trusted access and zero commissions. Number two, they monetized that massive asset pool, generating $11.75 billion in net interest income in just a single year. And number three, they locked those relationships in via B2B REI custody and B2C wealth services. I'll give you a few seconds to just let the sheer genius of that business logic sink in. But, of course, no model is totally invincible. Let's pivot to the macro risks, specifically the threat of cash sorting. So, what is cash sorting? Well, it happens when yield-aware clients kind of wake up and realize their idle sweep cash is earning very little, especially while interest rates in the broader economy are running high. So they actively move that cash out of the sweep account and into higher-yielding alternatives. Things like money market funds, treasury bills, or brokered CDs. And when this happens, Schwab's incredibly lucrative pool of low-cost deposits naturally shrinks. They either have to go out and find more expensive supplemental funding to replace it, or their net interest income takes a hit. But there's a really critical nuance here. Transactional sweep cash is highly rate sensitive. And yes, losing it definitely hurts the bottom line. However, when a Schwab client sorts their cash, they usually don't actually leave Schwab. They just buy a Schwab proprietary money market fund. So while it certainly compresses the spread, Schwab manages roughly $694 billion in their own money market funds. This generates fee revenue and acts as a massive platform stabilizer. To recap the overarching risks to this model, we've got cash sorting pressuring the net interest margin. We have interest rate shocks, which can absolutely cause unrealized losses on their massive securities portfolio. We have relentless industry fee compression. And critically, we have regulatory and reputational risk. Clients obviously love low cost, but they really don't like feeling taken advantage of when it comes to their cash. In fact, in 2022, Schwab subsidiaries agreed to a massive $187 million SEC settlement regarding undisclosed cash drag in their robo-advisor portfolios. Transparency in how they monetize cash is a major vulnerability they have to meticulously manage. Take a moment to consider how critical that trust factor really is. All right, Section 5, the valuation framework. Decoding the financial toll road. Wall Street is constantly struggling to value a hybrid beast like this. Are they a broker? Are they a bank? An asset manager? Well, the ultimate proof of this financial toll road's power comes down to this number, 50.0. In 2025, Schwab reported an adjusted pre-tax profit margin of 50.0%. Literally half of every dollar flows to profit before taxes. That is the immense operating leverage you unlock at this scale. Because once the complex technological infrastructure and the custody rails are already built, the marginal cost of adding the next $1 billion in client assets is incredibly low. Which leaves us with a pretty provocative final thought, based on absolutely everything we've covered today. The cash sweeps, the REA custody, the net interest margins. Is the $0 stock trade simply the world's most successful loss leader for an $11.7 trillion funding hub? Charles Schwab may have started out by making investing cheaper for the little guy, but they won by turning that cheap access into the single largest cash and asset aggregation system in America. The cheap trade gets you in the door, but the invisible balance sheet? Well, that's the empire. Thank you for joining me to decode the real mechanics of retail finance, and I'll leave you to think about that final question.